Did you know that even amidst high interest rates, multifamily housing continues to flourish, capturing the attention of investors worldwide? Welcome to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. Let's get right to it. In the ever-evolving landscape of real estate, the multifamily segment has managed to maintain its appeal despite the challenges posed by rising interest rates. According to Ana Luisa Tiegui from Valor, institutional investors are increasingly backing rental-focused projects, particularly in Brazil, as demand grows among middle-income tenants. This trend is not limited to Brazil, as similar patterns can be observed globally, including in Canada. The multifamily housing model, which involves residential buildings developed specifically for rental, is proving resilient. Asset manager Brio in Brazil has raised 250 million reais for a development fund dedicated to this segment. The funds are earmarked for the construction of 5 new buildings in São Paulo, totaling around 700 units, to be managed by Greystar, a company with a strong presence in this sector. This highlights the sustained interest and confidence investors have in multifamily housing despite the economic pressures. One of the key drivers for this continued interest is the middle-income market, which, as noted by Brio partner Mauricio Muniz, faces significant challenges in home ownership due to the lack of subsidies and expensive financing. This mirrors the situation in many parts of Canada, where high interest rates have also made home ownership more difficult for middle-income earners, thus increasing the demand for rental units. Interestingly, foreign institutional investors like Canada's Brookfield are also capitalizing on this trend. Brookfield has been active in the Brazilian market for several years, focusing on the middle-income segment. Andre Lucarelli, Senior Vice President of Investments at Brookfield in Brazil, stated that they tend to invest more during times of crisis than in prosperity, which aligns with the current economic climate. The appeal of multifamily housing lies in its ability to provide stable returns over the long term, even when immediate financial conditions are challenging. It's clear that the demand for rental housing remains robust, with occupancy rates for multifamily units ranging from 93% to 95%, according to Brookfield's data. This demand is driven by the necessity for affordable living spaces, especially as prospective homebuyers delay their purchases due to high costs. In Canada, particularly in cities like Hamilton, Niagara, and Kitchener-Waterloo, the multifamily housing market continues to be a promising investment opportunity. These areas are witnessing a similar trend as investors recognize the potential for growth and stable returns. With a focus on tenant leasing and multifamily developments, the real estate market in these regions is poised for continued expansion. In today's segment, we explore the Canadian Mortgage and Housing Corporation's CMHC Income Property Mortgage Loan Insurance product designed specifically for rental investments. This product opens the door to a range of financing options for investors purchasing small rental properties, particularly those with 2 to 4 units. As multifamily investments continue to thrive, this product offers Canadian investors a chance to expand their portfolios with added financial flexibility. The CMHC Income Property product is tailored for non-owner occupied properties, allowing investors to include up to 50% of the gross rental income from the property in debt service qualification calculations. This flexible approach helps investors meet the necessary financial criteria more easily, even amidst high interest rates. For those who prefer a net rental income approach, CMHC permits lenders to use their internal guidelines, considering gross rents minus operating expenses. Eligible borrowers for this product include Canadian citizens, permanent residents, self-employed individuals, and corporate borrowers who can provide a personal guarantee or co-borrower. With a loan-to-value ratio of up to 80% for small rental loans, investors need to ensure a minimum equity of 20%, making it a viable option for those looking to invest in the rental market. The properties must be located in Canada, with a maximum purchase price or lending value below $1 million and must be suitable for full-time, year-round occupancy. Investors can utilize traditional down payments from savings, the sale of a property, or a non-repayable financial gift from a relative, providing additional flexibility in financing. To ensure creditworthiness, At least one borrower or guarantor must have a minimum credit score of 600. CMHC also considers alternative methods of establishing creditworthiness for those without a traditional credit history. The debt service ratios are capped at 39% for gross debt service and 44% for total debt service, calculated using an interest rate that is the greater of the contract interest rate plus 2% or 5.25%. CMHC offers single advances for improvement costs up to 10% of the asset's improved value and progress advances for new construction or improvements exceeding 10%. With premium rates varying based on the loan-to-value ratio, this product remains an attractive option for investors seeking to diversify their holdings within the multifamily real estate sector. For those interested in maximizing their investment, CMHC provides a variety of financial planning tools, including mortgage calculators and quick reference guides. Additionally, CMHC's eco products offer a 25% partial refund on insurance premiums for energy-efficient homes, encouraging sustainable investment practices. In recent real estate news, Fredericton, New Brunswick, and Calgary, Alberta, have been named the best places to buy real estate in Canada, according to MoneySense and Zoocasa's 2025 edition of Where to Buy Real Estate in Canada. While Toronto and Vancouver are often seen as the epicenters of Canadian real estate, their high prices and low value growth have pushed them down in the rankings. The Greater Toronto Area came in at 33 out of 44, and Greater Vancouver was 39th. In contrast, Fredericton earned a value score of 3.74, with an average home price of $310,925 and significant growth over the past 5 years. Calgary followed closely with a value score of 3.69, showcasing healthy growth rates and a strong average income level. These findings highlight a shift in interest towards more affordable markets, which are becoming new real estate hotspots. The report reveals that while Toronto and Vancouver remain major players in the national real estate market, their core areas are experiencing price stagnation. This trend is pushing investors to explore opportunities in less saturated and more affordable places like the Prairies and the Maritimes. Carrie Lysenko, Chief Executive Officer of Zoocasa, noted this shift as buyers reevaluate their living situations due to the costs associated with urban life. The report also suggests that cities such as Regina, Saskatoon, St. John, and Edmonton are poised for substantial housing market growth in 2025, with home prices already increasing significantly in these areas. It's an exciting time for real estate investors who are willing to look beyond the traditional hotspots. As we've seen, markets like Fredericton and Calgary are proving that value can be found outside of the usual suspects. With the right strategies and insights, investors can capitalize on these emerging opportunities and potentially achieve impressive returns. This aligns with our focus on multifamily investments, where understanding market trends and recognizing potential is key to success. Thank you for listening to the Multifamily Real Estate Insights podcast. I'm your host, Sandy MacKay. See you on the next one.